You settle an old credit card balance, $10,000 owed, and after months of phone calls, the bank agrees to take $3,000 and close the account. You pay it. You hang up. And for the first time in years, that debt is gone. 14 months later, a form arrives in your post that you have never seen before in your life. It has your name on it, it has the bank's name on it, and it has a number on it. $7,000. Not a bill, not a demand for payment. Something stranger than that. The government now considers that $7,000 to be income you earned. Income you never received, never spent, and never held in your hand for a single second. And it is being added to your tax return for that year. On top of your Social Security, on top of your pension, on top of everything else. That is what happens when a debt gets forgiven in this country, and almost nobody finds out until the form arrives. Now, here is the part that actually matters, and it is the reason I am making this video rather than simply warning you. A very large number of the people who receive that form owe nothing at all. Not a reduced amount. Nothing. The law contains a specific protection built for exactly this situation. It applies to the majority of people who settle credit card debt, and it is claimed by filling out one additional form that most people have never heard of. But the protection is not automatic. Nobody applies it for you. If you receive that form, do nothing, and file your return the normal way, the government treats that $7,000 as ordinary income and taxes it accordingly. So this video is 4 things. 1. What actually triggers this? Because it is not only debt settlement, and the other triggers catch people who never negotiated anything with anybody. 2. The protection I just mentioned, exactly how it works, and how to know in about 10 minutes whether you qualify. 3. What to do when the form is simply wrong, which happens far more often than you would expect, on debts that were already paid, already discharged, or so old they should never have been reported at all. 4. The one decision people make in advance, before ever settling anything, that determines whether they end up in this situation in the first place. And I want to say clearly at the start because I know exactly how this video sounds. This is not a reason to avoid settling a debt. Settling debt is often the right decision. This is about knowing what arrives afterward, so it does not arrive as a shock in a year when you have already spent the money you saved. My name is Kevin. I read the rules so you do not have to. Every week I go looking for the thing that quietly decides what happens to your money, and I bring it here before it costs you anything. If that sounds useful, subscribe and turn on the bell, because the protection in the second part of this video has to be claimed on the return for the specific year the debt was canceled, and once that return is filed and settled, going back is considerably harder. Let me start with what actually triggers this, because most coverage of this subject only mentions settlement. And settlement is only one of 4 ways it happens. The form is called a 1099-C. The C stands for cancellation. A creditor is required by law to send it to you and to send a copy to the tax authorities whenever they cancel a debt of $600 or more. $600. That is the threshold. It is low. It has been low for a long time, and it means this reaches far more ordinary situations than people assume. Now, 4 ways this gets triggered. The first is the obvious one. You negotiate a settlement. You owed $10,000, they accepted $3,000, and the $7,000 difference gets reported. The second is the one that catches people completely off guard, a charge-off. A creditor decides an account is not collectible and writes it off internally. You did not negotiate anything. You did not agree to anything. You may not have spoken to them in years, and they can still issue that form on the balance they gave up on. The third is a debt collector deciding to stop pursuing you. When a collection agency concludes the debt is not worth chasing, that decision can trigger the same form on the same amount. And the fourth is a debt so old that the legal window for suing you has expired. In some circumstances, when a creditor formally acknowledges internally that a debt has aged out, that too can produce this form, on a balance from a decade ago that you had entirely stopped thinking about. So the picture is broader than settlement. You do not have to have negotiated with anybody. You do not have to have signed anything. In 3 of those 4 situations, the decision was made entirely on their side of the desk. And the first you know about it is a form in January. Now, the timing, because this trips people up badly. The creditor must send you that form by the 31st of January in the year following the cancellation. So, a debt canceled in the spring produces a form the following January, which lands on the return you file that April, which means there is a gap of anywhere from 2 to 14 months between the relief and the consequence. Long enough that the money you saved by settling has usually been spent. Long enough that most people have stopped connecting the two events entirely. And there is one more thing about that form worth knowing before I go on, because it tells you something useful about your own situation. There is a box on it, box 6, containing a code, a single letter. That code tells you why the creditor says the debt was canceled. 2 of them account for most of what this audience will ever see. Code F means you negotiated a settlement and they accepted less than the full balance. Code G means the creditor simply gave up on collecting and wrote it off, whether you spoke to them or not. Neither code changes whether you can claim the protection I am about to describe. Both are eligible, but knowing which one is on your form tells you immediately whether this came from something you did or something they decided on their own. And that matters when you are sitting there trying to work out where the form even came from, and a detail that catches people out. A creditor issuing that form does not always mean the debt is legally gone forever. In some situations, a debt can be reported as canceled for tax purposes and still be pursued afterward, particularly if it was sold to a collection agency. So, receiving one of these is not automatically proof that the matter is closed. And if anybody contacts you about the same balance later, that is worth questioning rather than simply paying. Let me tell you about Delford. Delford is 71, and 18 months ago, he did something he had been putting off for 4 years. He telephoned the bank about a credit card balance he had not been able to keep up with since a hospital stay, and he settled it. $9,200 owed. They accepted $2,800. He borrowed from a brother to pay it, and he has been paying his brother back a little every month since. He described that phone call to his daughter as the best hour he had spent in years. The relief was enormous. The account closed. The calls stopped. The following January, a form arrived reporting $6,400. He did not know what it was. He assumed it was a statement of some kind and set it aside. He gave his tax preparer his usual documents in March, and the form was not among them, because he did not recognize it as a tax document. What Delford did not know is that the tax authorities also received a copy of that form, and their system matches what they receive against what you report. When those two do not match, a notice goes out automatically, and the notice that eventually reached him was for tax on the full $6,400 plus interest and a penalty. And here is what makes it genuinely painful. Delford almost certainly qualified for the protection I mentioned at the start, and would have owed nothing at all. He simply did not know the form mattered, so he never told anybody about it. That is the whole reason the quiet rules exists. Plain English, printed large enough to read without hunting for your glasses, on the things that quietly decide what happens to your money, what each form actually is when it arrives, which ones matter, and the exact question to ask before you hand your papers to whoever does your return, so that nobody pays tax on money they never received simply because a form did not look important. It is at kevinexplains.shop. The link is in the description below and in the pinned comment at the top. And if you are watching this on a television right now, there is a code on the screen you can point your phone camera at. 7-day guarantee always. If it does not hand you something you did not have before, you send it back. So here is a question worth sitting with. If an unfamiliar tax form arrived in January, would you recognize it as something that mattered, or would you set it aside the way Delford did? Now the protection, and this is the most valuable section of this video, so stay with me. It is called the insolvency exclusion, and the word insolvency sounds far more dramatic than what it actually means here. Here is the entire test. Immediately before the debt was canceled, did your total debts exceed the total value of everything you owned? If yes, you were insolvent in the eyes of the tax code, and you can exclude the canceled amount from your income up to the amount by which you were insolvent. That is it. That is the whole rule. There is no application, no hardship review, no committee deciding whether you deserve it. It is arithmetic. And here is why this matters so much. Think about who actually ends up settling a credit card debt. It is generally somebody whose debts had grown larger than their resources. That is why the debt became unmanageable in the first place, which means a very large share of the people who received this form were insolvent at that moment, by the tax code's own definition, and are entitled to exclude some or all of it. Let me walk through the arithmetic, because it is simpler than people expect. Add up everything you owed immediately before the cancellation. Every credit card balance, any mortgage, any car loan, medical bills, any other debt of any kind. That is, your total liabilities. Then add up the fair market value of everything you owned at that same moment. Your home, if you own one, your vehicle, money in the bank, retirement accounts, personal property of real value. Let me be more specific on both sides of that, because this is where people either overstate their assets and lose the exclusion, or understate them and create a problem later. On the liabilities side, include everything, and people routinely leave things out. Every credit card balance, including the one being canceled, your mortgage, if you have one, a home equity line, car loans, medical bills you still owe, including ones on a payment plan, student loans, including any you took out for a child, money owed to family members if there is genuine documentation of it, past due utility bills, any tax you owed at that moment. Every one of those counts, and every one you leave out makes you look less insolvent than you actually were. On the asset side, use fair market value, which means what something would actually sell for, not what you paid for it and not what it is insured for. A 12-year-old car is worth what a 12-year-old car sells for. Household furniture is worth almost nothing on the open market, regardless of what it cost. Your home is worth what comparable homes in your area are actually selling for, minus nothing, because the mortgage against it is already counted on the other side of the ledger. And retirement accounts do count as assets. That surprises people, and it is the single item most likely to change the arithmetic for somebody in this audience, because a person with a modest retirement account and a manageable amount of debt may not be insolvent at all, even though they felt broke enough to settle. Here's how it plays out. Suppose your total debts were $80,000 and your total assets were $50,000. You were insolvent by $30,000. If the canceled amount on your form is $12,000, the entire $12,000 is excluded because it fits inside your $30,000 of insolvency. You owe nothing on it. But if the canceled amount were $35,000, you could exclude $30,000 and would owe tax on the remaining $5,000. So, the exclusion is capped by how insolvent you were, and for most ordinary cases involving a credit card balance, the canceled amount sits comfortably inside that cap. And there is a second exclusion that is even more complete, though it applies to fewer people. Debt discharged in bankruptcy is entirely excluded from income. No calculation, no cap, no arithmetic at all. If a debt was wiped out through a bankruptcy case, the tax on it is zero, full stop. I mention that because it is one of the genuinely underappreciated differences between the two routes. When you settle a debt, you may owe tax on what was forgiven. When a debt is discharged in bankruptcy, you never do. That is not a recommendation, because bankruptcy carries consequences that settlement does not. It is simply a fact that almost never gets mentioned when people weigh the two. Now, how do you actually claim it? The form is called Form 982. It is short. You attach it to your tax return for the year the debt was canceled, you check the box indicating which exclusion applies to you, and you enter the amount being excluded. And here is the sentence I most want you to remember from this entire video. If you receive that cancellation form and simply ignore it, the exclusion does not happen. The tax authorities have their copy. Their system matches it against your return. When your return does not account for it, a notice goes out, and by then you are arguing backward instead of filing correctly the first time. So the instruction is straightforward. If that form arrives, do not set it aside and do not panic. Give it to whoever prepares your return and say these words: I received a cancellation of debt form, and I believe I may have been insolvent at the time. Can we look at Form 982? That single sentence, spoken in March, is the difference between owing nothing and owing thousands. And keep documentation of the arithmetic. Not receipts for everything, but a written record of what you owed and what you owned at that moment, with account statements supporting it. If the exclusion is ever questioned, that record is what settles it. Let me tell you about Roxie. Roxie is 67, and she went through a debt settlement program 2 years ago, after her husband's illness left the household with balances on 4 different cards. She did everything carefully. She kept every letter. When the cancellation forms arrived, 3 of them, in the same week in January, she recognized what they were because she had read about them beforehand. She took them to her preparer, along with a single sheet of paper on which she had written every debt the household owed on the date each one was canceled, and every asset they held, with the account balances written beside them. Her preparer filed Form 982. All 3 exclusions were claimed. The household owed nothing at all on more than $22,000 of canceled debt. The entire difference between Roxie's outcome and Delford's was not their circumstances. Their circumstances were remarkably similar. The difference was that one of them knew the form mattered before it arrived, and the other did not. That is exactly the gap this guide closes. Not to make anybody a tax expert, to put the handful of forms that actually change your outcome in one place, in plain language, so that a person opening their post in January knows immediately which envelope is worth a phone call and which one is not. Same place, kevinexplains.shop, link in the description and in the pinned comment at the top, and the code on your screen if you are watching this on the television. 7-day guarantee, no argument. A woman with 3 forms and 1 handwritten sheet of paper, owing nothing on $22,000. Now, the third thing. What to do when the form is simply wrong. This happens far more often than people realize, and there are 4 common versions of it. The first is a debt that was already paid. A creditor's records get out of date, an account moves between departments, and a form is issued on a balance that was cleared years earlier. The second is a debt that was never yours. Identity errors, similar names, or an account you were never actually responsible for. The third is the wrong amount. The figure on the form includes interest or fees that were never legitimately owed or simply does not match what was actually canceled. And the fourth is one I covered in another video on this channel and will only touch on here. A debt so old that the legal window for collecting it had already expired, being reported as though it were recently canceled. In every one of those cases, do not simply pay the tax to make it go away, and do not ignore it either, because ignoring it produces an automatic notice regardless of whether the form was accurate. Here is what to actually do. Contact the creditor in writing and request a corrected form. Explain specifically what is wrong. Already paid, and here is the proof. Not my account. Wrong amount, and here is what the correct figure should be. If they issue a corrected form, that resolves it cleanly. If they will not, you can still file your return correctly and attach a statement explaining why the form is inaccurate and what you believe the correct treatment is. That is a legitimate path. It is used regularly, and it is considerably better than either paying tax you do not owe or leaving a mismatch sitting in a government system unaddressed. And one honest caveat about the exclusion that almost nobody mentions, because I would rather you hear it from me than discover it later. When you exclude canceled debt using that form, the tax code asks for something in return. It is called reducing your tax attributes, and what it means in practice is that certain carried forward tax benefits get reduced by the amount you excluded. Things like capital loss carryovers, or the cost basis in property you own. For most people in this audience, that has no practical effect whatsoever. If you do not have loss carryovers and you are not planning to sell property, there is nothing there to reduce, and the exclusion is simply free. But if you are carrying a large capital loss from a bad year in the market, or you own investment property you intend to sell, that reduction is real, and it is worth having whoever prepares your return look at it properly rather than treating the exclusion as consequence-free. It is still almost always the right choice. It is just not quite as clean as most explanations make it sound, and you deserve the whole picture rather than the convenient half of it. Now, the fourth thing and this is the decision people make before any of the above ever happens. If you are considering settling a debt, or you are working with a company that settles debts on your behalf, ask one question before you agree to anything. What will the tax consequence of this settlement be? And will I receive a cancellation of debt form? A great many people who work in that industry will answer that question honestly. Some will not mention it at all unless asked, because it is not the part of the conversation that closes a deal. And here's the practical planning that comes out of asking. If you know a form is coming, you can prepare for it. You can document your financial position at the moment of cancellation, while the records are current and easy to gather, rather than trying to reconstruct it 14 months later from memory. That documentation is exactly what supports the insolvency exclusion, and gathering it on the day is dramatically easier than gathering it the following spring. That is the single most useful thing in this video for anybody who has not settled yet. Write down what you owe and what you own on the day the debt is canceled, and put that sheet of paper somewhere you will find it in January. And one more thing that belongs here because it changed this year, and it affects a group of people in this audience who will not see it coming. For several years, forgiven student loan debt was specifically excluded from income by a temporary provision. That provision expired at the end of last year and was not extended, which means student loan forgiveness received this year may now be taxable income in a way it was not for the past several years. I mention it because a number of people watching this took out loans for a child or a grandchild decades ago, and because forgiveness programs for older borrowers do exist. If any debt of that kind is forgiven for you this year, the same cancellation form applies, the same insolvency exclusion is available, and the same silence surrounds it. Now, a warning before the checklist, because a video like this one draws exactly the wrong kind of attention. Nobody legitimate will telephone you offering to make a cancellation of debt form disappear, to settle your tax on forgiven debt for a fee, or to file a special claim on your behalf that you cannot file yourself. The exclusion form is free. Filing it is free. Your own tax preparer can handle it. And if you do not have one, free tax help programs exist specifically for people over 60. And if anybody calls claiming to be from the tax authorities demanding immediate payment on forgiven debt, that is not how any of this works. Notices come by post. They do not begin with a telephone call demanding payment that day. Now let me give you my honest opinion, which is only that. And you are welcome to disagree with me in the comments. I understand the logic behind this rule, and I want to state it fairly before I object to any part of it. The reasoning is that if you borrowed $10,000 and only ever repaid $3,000, you effectively kept $7,000 of somebody else's money. You got the benefit of it. You bought things with it. So, the tax system treats that benefit as income the same way it would if somebody had simply handed you the money. That is not an unreasonable position. If the rule did not exist, forgiveness could become an easy route around income tax entirely, and the people best placed to exploit that would not be the people in this audience. My objection is narrower, and it is about timing and notice, rather than the principle. The consequence arrives up to 14 months after the relief, in the form of a document most people have never seen before, with no explanation attached to it of what it means or what protections exist. There is no line on that form that says, "You may not owe anything on this, ask about Form 982. There is simply a number and a name and a great deal of silence. And the people receiving it are, almost by definition, the people who were in financial difficulty. That is why the debt was canceled. So the group least equipped to absorb an unexpected tax bill is the group this rule reaches. And the protection built specifically for them is the one thing nobody tells them about. That is not a design anybody sat down and intended. It is the ordinary result of a form being written to satisfy a reporting requirement rather than to inform the person receiving it. But the effect on a 71-year-old man opening his post in January is the same either way. And there is a second thing I want to say, because it is the part that would actually fix this, and it costs nothing. Every one of these forms could carry a single additional line, something as simple as, "You may not owe tax on this amount. Ask about the insolvency exclusion." One sentence. It would not change the law. It would not cost the creditor anything meaningful. And it would very likely eliminate most of the harm this rule causes to ordinary households. The information exists. The protection exists. The form exists. The only missing piece is anybody thinking to connect the three on the one piece of paper that reaches the person affected. And that is the pattern this channel keeps arriving at, in subject after subject. Not concealment, not malice, not some plan against seniors. Just a rule written by one part of a system, a protection written by another part, and nobody anywhere assigned the job of telling the person in the middle that both exist. All right, here is your list. 5 things. 1. If a cancellation of debt form ever arrives, do not set it aside and do not throw it away. It is a tax document, the government has a copy, and it must be addressed on your return, one way or another. 2. Before you assume you owe anything on it, work out whether you were insolvent immediately before the cancellation. Total debts against total assets. If the debts were larger, some or all of the canceled amount may be entirely excluded. 3. Tell whoever prepares your return, in these words, that you received a cancellation of debt form and believe you may have been insolvent, and ask about Form 982. 4. If the form is wrong, and they frequently are, request a corrected one in writing, rather than either paying it or ignoring it. 5. If you are considering settling a debt, ask about the tax consequence before you agree, and write down what you owe and what you own on the day it is canceled. And if your own situation is tangled, if you are holding one of these forms and cannot work out what it means for you, write to me. The address is on your screen and in the description below, and I read every one that comes in. One last thing before you go. Delford made the best decision he had made in 4 years, and then received a document he did not recognize and set it aside, and it cost him considerably more than the relief was worth. Roxie went through very nearly the same experience, with the same kind of debts and the same kind of settlement, and owed nothing at all. Neither of them was smarter than the other. Neither of them had better circumstances. One of them simply knew what was coming before it arrived, and had a single sheet of paper ready when it did. So, if you are ever in that position, or somebody in your family is, remember the 2 things that separate those 2 outcomes. Recognize the form when it comes, and write down what you owed and what you owned on the day the debt went away. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.